Welcome back, friends. As I had mentioned or predicted over the weekend, that we will be shortly seeing a good rebound in world financial markets. And particularly, this was also aimed at India because the Indian markets have been languishing much behind world financial markets. You have seen a very good rebound in the Indian stock markets, with the Nifty up almost 600 points over the last 2 days, which is quite a good rebound, I would say, over the rather languishing nature of the Nifty and the Bank Nifty. So here we go. After a huge fall, we have finally seen some good movement, upward movement in the Indian stock markets. I would hasten to add that the scenario will be good for a certain period of time. So do not treat this, in my opinion, as a bottom. But yes, the rebound characteristics are here, and enjoy the rebound while it lasts. And that's the message which I'm trying to give you before the new fall comes. And to get to know when the new falls are coming, do join our Premium Plus, which gives you 10 to 12 days predictions in advance, plus good stock and multi-bagger recommendations, which should do well in any market, up or down. Germany's historic turnaround on public spending has sent shockwaves to the financial markets, sending the euro and the Germany government borrowing costs sharply higher. The euro shook off its usual fears about economic stagnation and Europe's strategic vulnerability to surge against the dollar in early trading on Wednesday. While the German government's 10-year borrowing costs leaped by nearly a quarter of a percentage to the highest in 17 months, as investors raced to factor in the game-changing impact of hundreds of billions of euros in spending on defense and infrastructure projects in Germany. The moves are a reaction to the announcement on Tuesday that the Germany's Chancellor-in-waiting, Friedrich Merz, had struck a deal with his prospective coalition partners, SPD or the Social Democrats, to effectively bypass a constitutional cap on the budget deficit. The news came on the same day that the European Commission President Ursula von der Leyen had proposed raising hundreds of billions more to restore Europe's defense capacity. You must have seen that European defense stocks have surged over the last week, just immediately after the breakdown of talks between United States and Ukraine to end the war, Ukraine-Russia war. Europe and Germany in particular are showing a historically unprecedented responsiveness to revising the fiscal stance. And this rate of the Bund, the German Bund, is probably something which reminds you of the rates that prevailed just a little bit after the fall of the Berlin Wall. Prospects of a fiscal bazooka pushed the single currency up 0.7% against the dollar to 1.0722. That's the highest rate for the euro as compared to the US dollar since November. We can expect the rally to continue until at least the euro hits 1.10. And while not everyone is so enthusiastic, analysts have quickly dropped predictions that Europe's weak economic outlook could push the euro down to parity with the greenback this year. So things have changed dramatically. Merz's plans, which will largely exempt defense spending from the so-called debt brake, and also include a 500 billion euro special fund for infrastructure spending over the next 10 years, still will have to pass Parliament later this month. To this end, Merz and the outgoing Chancellor Olaf Scholz will still have to win over the Greens, which is widely expected to happen. In view of the threats to our freedom and peace on our continent, whatever it takes must now also apply to our defense. These are the famous words, whatever it takes, that were said by Frederick Merz, reviving the phrase of the then European Central Bank President Mario Draghi that proved to be the turning point in Europe's sovereign debt crisis a decade ago. Tuesday's deal signaled a radical departure from the obsession with debt sustainability that has characterized German policy since the global financial crisis and arguably before then. While economists still want to see its small print, they are in no doubt of its transformative potential. Pending more clarity on this issue and being mindful of some execution risk, we believe this is one of the most historic paradigm shifts in German post-war history. So, friends, here we stand. Other things being equal, the move should reverse the downward pressure that the German fiscal policy has put on the euro since 2009, when Angela Merkel introduced a debt brake. However, with an eye on the looming trade war with the United States, what complicates things is that at present all else is not equal in a rather extreme way. The imposition of import tariffs by the United States and the effect that this may have on the US economy works at cross purposes, with the German news making it harder to say how much higher the euro can go. What is clear is that a brave new world of fiscal largesse will also have a cost. Germany's borrowing cost has surged following the announcement, with the yield on the 10-year German Bund note rising more than 20 basis points to about 22.7%, marking the biggest jump since June 2022. You would also have seen a rise in Japanese yields. Now, this rise in the German 10-year note also had a knock-on effect on pulling borrowing costs for all Eurozone government up in parallel. Germany's 30-year yields were on course for their biggest one-day rise since the late 1990s. To some, that's an alarming reminder of why the debt brake was there in the first place. Friedrich Hennemann, an economist with the ZEW think tank in Mannheim, warns that a reform is going too far and the risk debt levels can spiral out of control. This also is very much synonymous with the situation in the United States, where the debt levels are so out of control that now the government had to finally resolve to bring in the Dutch to find ways and means of controlling the debt. The Christian Democratic Union or the SPD deal would allow Germany to finance 4% of the GDP in debt at any time. This would quickly put Germany among the highly indebted countries of the European Union, and the debt to GDP ratio will reach 100% as early as 2034. That's not a very good signal. Today is the day when the debt brake will become history. Germany could lose its function as a safe haven for bondholders. Interest rates and inflation definitely on the front burner. To get to know more where the world financial markets are headed, particularly where we expect the German DAX and also the US, the Wall Street, the Dow, S&P, and NASDAQ, do join our Prime or Prime Plus groups, which I address specifically for the US markets and the German markets. You can do that by WhatsApping us on 982-086-1044. To get to know more where the Indian markets, the Nifty and the Bank Nifty are headed, do join our Premium Plus, which gives you 10 to 12 days predictions in advance, plus good multi-bagger recommendations. To subscribe to any of these, do WhatsApp us on 982-086-1044. You can alternatively also email us at globalmoneyinvestor@gmail.com. GLOBALMONEYINVESTOR@gmail.com. Happy investing. Take care. Bye-bye.